Covered calls are actually pretty simple to place, but there's still a few things you really need to understand before you ever start using them. Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions. Here's what a covered call actually is. It starts with you already owning 100 shares of a stock or ETF. That matters because one call option controls 100 shares. So once you own those shares, you can sell one call option against them and you collect premium up front. That premium is yours to keep no matter what happens in the trade. In return, you're agreeing to sell your shares at a set price called a strike price if that stock moves above that level before expiration. So the real trade-off is this. You collect extra premium now, income. You give up some potential upside if the strike moves above the agreed upon strike. If that stock stays below the strike, you keep the premium and you keep your shares. If the stock moves above the strike, your shares can be called away and you'll end up keeping the premium and you'll profit from the capital appreciation of that move. And that's why covered calls are a practical income strategy. Now let's talk about the premium because this is where a lot of people get confused. That premium is not free money. It just happens to appear out of nowhere. The buyer is paying you for the right that comes with that contract. A simple way to think about it is like insurance. The buyer is paying the premium and you as the seller are collecting that premium in exchange for taking on the obligation. In a covered call, that obligation is simple. If the stock moves above the strike price before expiration, you may have to sell your shares to the buyer at that price. So the premium is the payment you receive for agreeing to that trade-off. That's why covered calls can create income, but that income always comes with a condition attached to it. You're getting paid today because you may be giving up a little upside later. Covered calls can be a very useful strategy, but they're not for everybody. They make the most sense for somebody who already owns or wants to own 100 shares of a stock or ETF and is looking to create some extra income on that position. They also make more sense for somebody who's comfortable with options and willing to at least check the trade regularly. Now, that doesn't mean you have to stare at charts all day, but you should be willing to manage that position if needed. On the other hand, this is probably not the right strategy for somebody who is uncomfortable with options, hates the idea of capped upside, or just wants to sell calls blindly for premium without really understanding the trade. So covered calls can be a great fit, but only if they match your personality, your goals, and your willingness to manage that position. Before I even think about selling a covered call, I want the stock or ETF itself to make sense. Because if the stock is not good enough to own, it's probably not good enough for me to build a covered call strategy around. One of the biggest mistakes people make is chasing premium on weak stocks just because the options look attractive. In my opinion, that's completely backwards. The covered call is the income layer. The stock is the foundation. So I'd rather use this strategy on a company I already own, already follow, and would actually be comfortable owning. Also, decent liquidity in a stock that I would not mind holding if it chops around for a while. So before I even look at an option, I want to feel good about the shares themselves. So for me personally, I also want a stock to pass a basic quality test before I even think about selling a covered call on it. Now, I'm not going to break down all 7 of my fundamental principles in this video because that could be a video of it itself. But I do want to make one thing very clear. I do not want to build a covered call strategy around a stock that I would not feel good owning in the first place. So covered call is the extra income piece. The stock itself has to make sense first. So even though this video is about covered calls, I still want the quality of the company that matters before the option ever does. Most of the money that's made in covered call covered call strategies is actually in the capital appreciation of the stock that you own while you're on your way up. Covered calls also connects to a couple other strategies you may have heard of. That would be the buy right and the wheel. The covered call usually means you already own 100 shares of stock and then you sell the covered call against those for extra income. A buy right's a little different because you buy the shares and immediately sell the covered call at the same time, usually with the intention that those shares will get called away very soon. And then there's the wheel strategy that begins with selling a cash secured put. And when you get assigned those shares, you now own 100 shares and you move into selling calls against them right away. So those are related, but they're not exactly the same thing. And the intention behind them can be a little bit different. One of the biggest lessons I've learned with covered calls is this: make a plan first and then stick to it. Early on, I would sometimes set up a covered call, be perfectly happy with the premium and perfectly happy with the strike price, and then the stock would rip higher. And the minute that happened, I'd start feeling like I made a mistake. But a lot of times, the real mistake was not the trade. The real mistake is letting FOMO change the plan after the trade was already working. If I sold the covered call above my cost basis, collected the premium I wanted, and understood how the trade is going in, then it was still a good trade. Could the stock have gone higher? Sure. But that doesn't automatically mean the trade was wrong. So one of the most important parts of using covered call as well is understanding the trade-offs ahead of time and accepting the win that you planned for. Before I sell a covered call, I want to run through a simple checklist. First, do I want to own this stock? Second, is this a quality name or am I just chasing premium? Third, do I understand what I'm being paid for? Fourth, am I okay if the shares get called away? And fifth, am I following a plan or am I just forcing a trade because I want some income right now? That checklist may sound simple, but honestly, it could save you from a lot of bad covered call decisions. Because the more boxes you check before the trade, the better chance you have of using that strategy the right way. So at the end of the day, a covered call is pretty simple strategy, but simple doesn't mean you should do it blindly. You still want the right stock, the right expectations, and a clear plan before you ever place the trade. If you understand the trade-off, stay disciplined, and use a strategy on stocks that actually make sense, covered calls can be a very practical way to generate extra income. If you have questions about covered calls, drop them in the comments. And in the next video, I'm actually going to walk you through a covered call that I'm going to place in a broker platform. I'll show you step by step how to do it. If you want more practical step-by-step option content, make sure you like and subscribe. Thanks again. Goodbye.